You lost money today, and yesterday, and every day before that.
Two people sell the exact same amount of Bitcoin on the same day for the same price. One reports a large gain, the other reports almost nothing. Same coin, same sale, same dollars. So what's different? It isn't the blockchain and it isn't luck. The difference is cost basis, which specific Bitcoin each of them sold. Because here's the thing almost nobody tells you. When you sell Bitcoin, you are not selling some abstract pile. You are selling particular coins you bought at particular prices on particular days. And the rules let you, in some cases, choose which ones. The person with clean records got to choose the coins that gave them the smaller gain. The person without records did not get to choose at all. A default rule chose for them, and it usually chose the worst answer. That is the entire episode in one sentence. When you can't prove which Bitcoin you sold, you lose control of the story your taxes tell. Last episode, we drew the line between a Bitcoin move that's just record keeping and a move that's actually a taxable event. A sale, a swap, a payment for something. Once you know a sale happened, the very next question is the one most people never even think to ask. Which Bitcoin did you sell? The coins you bought first, years ago, when it was cheap? The coins you bought last, near the top? The most expensive ones? Each of those choices produces a completely different gain or loss, even though the sale looks identical on your bank statement. That choice has a name. It's called your cost basis method. It is not a trick, and it is not a loophole. It is simply the accounting question of which lot left your stack. And whether you get to answer it on purpose or have it answered for you by default comes down entirely to your records. So let's make it concrete. Say you bought Bitcoin 3 times. In January, you bought a chunk at $42,000. In June, you bought more at $61,000. And on a random payday, you grabbed a little at $58,000. That is not one position. That is 3 separate lots, each with its own date, its own price, its own fees, and therefore its own cost basis. Now you sell a piece. If the rules treat you as selling the January coins first, your cost basis is low, so your taxable gain is large. If instead you can specifically point to the June coins, the ones you bought high, your basis is high and your gain is small, maybe even a loss. Same sale, same proceeds, wildly different tax outcome. Let's actually run the numbers because they're startling. Say you sell a tenth of a Bitcoin for $6,350. Under the default rule, you're treated as selling your earliest coins first, the January lot you bought at $42,000. So your cost basis is about $4,200, and your taxable gain is roughly $2,150. But if your records let you specifically identify the June coins, the ones you bought high at $61,000, your basis is about $6,100, and your gain is only around $250. Same identical sale. One version is a $2,100 gain. The other is a $200 gain, almost 9 times smaller, on the exact same transaction. The coins are identical on the blockchain. The only thing that changed is which lot you could prove you sold. And that is a records question, not a market question. So, how do the rules decide which lot you sold? There are really 2 paths, and the difference between them is everything. The first path is called specific identification. If, no later than the moment you sell, you identify the exact units you're selling by their purchase date or their purchase price, and you keep records that back that identification up, then that is a specific identification. This is the only way to deliberately sell, say, your highest cost coins first, the thing people call HIFO. And this is the part that trips everyone up, so hear it clearly. HIFO and LIFO are not buttons you press at tax time. They are not settings you flip in April. They are simply the result of doing specific identification correctly in advance with adequate records. If the records and the timing aren't there, those options quietly disappear no matter what software you bought. The second path is the default, and it is what happens to most people whether they like it or not. If you don't make that specific identification at or before the sale, the rules treat your coins as sold in order, starting with the earliest ones you acquired in that wallet or account. Earliest in, first out, FIFO. And I want to be precise about this because it is the most common mistake in the entire space. FIFO is not a strategy you choose to minimize taxes. FIFO is the fallback you land on when your records cannot support anything better. In a long bull market, your earliest coins are usually your cheapest coins, which means FIFO by default tends to hand you the largest possible gain. The default rule is not on your side. It is just the rule that applies when you didn't or couldn't do the work. And notice how quietly this happens. Nobody sits you down and says, you are now using FIFO, and it will cost you. There is no warning, no checkbox, no alert. You just sell some Bitcoin. You don't make a specific identification because you didn't know you were supposed to. And months later, your basis defaults to the oldest, cheapest coins in that account. The penalty for not keeping records isn't a fine. It's a larger tax bill that you never see coming, applied automatically, in the one direction that never favors you. That is why this episode is really about records, not about taxes. The tax rule is fixed. Your records are the only part you control. And here is what changed recently, because this is exactly where older advice is now wrong and dangerous. As of 2025, all of this works per wallet and per account. You can no longer treat all of your Bitcoin everywhere as one giant universal pool and pick whichever lot is convenient. The lot you identify has to actually live in the specific wallet or account you are selling from. If you sell from your exchange account, you identify among the coins in that account. If you sell from a particular cold storage wallet, you identify among the coins in that wallet. This sounds like a technicality, but it has teeth. It means your records have to be organized wallet by wallet, not just as one big spreadsheet of everything you've ever owned. Clean per wallet records are no longer a nice to have. They are the thing that decides whether you even have the option to choose your basis at all. Now the obvious objection, my exchange tracks all of this for me, so why should I care? Partly true, and it's getting more true, but it's a trap to rely on it. Starting with 2025 sales, brokers report your gross proceeds on a new form, the 1099-DA, and basis reporting phases in after that for later years. There's even temporary relief for 2025 that lets you identify lots through your own books and records. But here's the catch that no exchange can solve for you. An exchange only knows what happened on its own platform. The moment you buy on one exchange, withdraw to cold storage, move between your own wallets, and eventually sell somewhere else, no single platform has your whole history. The 1099-DA will confidently report what you sold for. Only your records can prove what it actually cost you. And when those two numbers don't match, the gap doesn't land on the exchange. It lands on you. Usually in April, when reconstructing a year of wallet movements from memory is the last thing you want to be doing. Picture the realistic version. You bought on one app 2 years ago, moved the coins to a hardware wallet for safekeeping. Later sent some to a different exchange because the fees were better and sold there. The exchange where you sold sees coins that simply appeared in your account. It has no idea what you originally paid, because that purchase happened somewhere else entirely. So its form may show proceeds with a basis it had to guess at, or no basis at all. If you just copy that form onto your return, you might massively overstate your gain and overpay, or understate it and invite a letter. Either way, the only thing standing between you and that mess is a record you kept at the time of purchase, in the wallet the coins actually lived in. So what do you actually keep? It's simpler than it sounds. For every lot, you track two halves. When you acquire, the date, the amount, the price you paid, the fee, the platform you bought on, and the wallet the coins landed in. When you dispose, the date, the proceeds, the fee, and your evidence of which specific lot you sold. Acquisition on one side, disposition on the other, and a clear thread connecting the two. That's it. Do that consistently, and the question that terrifies people at tax time, which Bitcoin did you sell, stops being a panic and becomes a line you simply read off your own records. You don't reconstruct anything. You don't guess. You don't pay the lazy FIFO tax just because you couldn't prove otherwise. The work is small and boring when you do it as you go, and brutal when you save it all for the end. That layer, the boring records layer, is exactly what our tools are built to organize. A clean, consistent place to log your lots, your basis, and your disposals, so the paper trail simply exists before the moment you need it, instead of being something you scramble to rebuild under a deadline. I want to be careful here. It is an organizer, not tax software, and nothing in this episode is tax, legal, or financial advice. Your situation has details I can't see, and for anything specific, you should talk to a qualified professional who can look at your actual records. The goal of all of this is narrow and honest. When the question comes, and it will come, you want the answer to live in your records, not in your memory. Memory loses every argument with the tax code. Records win them. Next episode, we take these records one step further. We'll walk through how a Bitcoin sale actually shows up on the tax form itself. Form 8849. What changes now that the 1099-DA exists, and how to reconcile your own records against what the broker reports, because that is where tax season quietly turns ugly. When your lots don't match the forms, you get letters. When they do match, you get a quiet, boring filing, which is exactly what you want. Clean basis is only half the job. The other half is making it all line up on paper. That's next, on Exit Velocity. If today made the picture clearer, the best thing you can do is keep your records as you go, one lot at a time, starting with your very next buy. Think in Bitcoin.